Hello. Shares are one of the most popular forms of investment. As there can be many differences between shares and shares, it is important to know these differences in order to choose and buy the one that is best for you. Before we dive into the topic, let me say in the beginning that what you will see here shares is only for a better understanding, as an illustration. It is in no way intended to get you to buy them. If you are interested in the world of investing, please contact us at the link in the description so that one of our staff can help you make the right choice. Of course, any type of share is suitable to be part of your investment basket, but the recommended time horizon for shares is over 5 years, so they are typically a long-term investment. That's why it's important to include assets recommended for the short and medium term in a properly designed investment basket. In the section on stocks, it was already mentioned that there are different specific types of stocks, such as ordinary shares, employee shares, preference shares, treasury shares, interest-bearing shares, or convertible bonds. However, you will generally not be able to buy these. It is good to know what they are, because if you come across them, for example because they are offered to you as an employee benefit, you will know what they are. It is also good to know about them if you are a share issuer yourself, because you are a financial manager, owner, or whoever, who are an important decision maker in the company in that respect. Well, even then it's essential that you know at least a rough idea of what you're making decisions about. Also, in the section on shares, we talked about the most common shares that you might come across if you want to buy shares through, say, a securities account. It was also said that there will be significant differences even between ordinary shares. Today we will talk about those differences. We will review the main grouping criteria. Of course, you can also find breakdowns outside of these, such as equity market sectors, which will be the subject of another video. My aim with this section is to make you see and understand that just because you have chosen to invest in equities, you still need to consider the individual characteristics. The first grouping criterion is grouping by size. The size grouping is determined by the current market capitalization. This can obviously change over time as the company evolves, and there is no hard and fast cutoff point to describe as there is, for example, to describe the SME sector. Therefore, don't be surprised if one analyst mentions a company one category higher or lower than another. Capitalization is the basis for the definition of a company's current value, the total number of shares in a company multiplied by their current price. Put very simply, this is how much money you would need at that moment to buy all the shares outstanding. It's a theoretical number, obviously no one will try this in real life, but as a guide it's perfect. It can be used as a basis for companies small, medium, and surprisingly, large. Let's take them in turn and look at the small ones first. You'll come across them as small cap stocks. They typically have a capitalization of under $2 billion. If you choose such shares, they have the potential for growth, but at the same time it is not a law. Obviously, the risk of bankruptcy or even a takeover by a larger company is also mostly in the packet. When looking at short time horizons, small companies are more volatile than large ones, and therefore their risk is higher. Looking over a longer time horizon, however, they are more likely to outperform the big ones. When is a small capitalization a good choice for you? It is if you are willing to wait for the small company to grow. That is, you're willing to hold on to your investment for years, provided you can handle the sometimes overwhelming feeling of high volatility. If you choose well and wait for growth, you can significantly increase the average growth rate of your portfolio by taking this step. Obviously, risk and reward go hand in hand. With these companies, it is possible that they fail because of a recession, market change, or whatever, and with this your money will be wasted. You can avoid this by either diversifying yourself, so splitting your money between several small companies, or by specifically choosing a mutual fund that focuses on these companies. With a mutual fund, your money is allocated to more than one company and you don't have to decide which one to invest in. After an overview of small firms, let's look at what is typical for medium-sized companies. You may also find them called mid-cap stocks. They typically have a capitalization of between $2 billion and $10 billion. These are companies that are still relatively young, growing fast, but have outgrown their origins as small-cap companies, so they have less of the observed teething problems. But it can also include older firms that are in a stable, dynamic, profitable market sector and therefore still have growth potential. Medium capitalization companies are between at the two extremes, between the small and the large, in terms of growth rate, risk, and volatility. This is not surprising, as they are at the midway point of their development. It is therefore just right for those who want to get the golden mean for their money. In other words, who are looking for growth and therefore profitability, but also some degree of safety in the same security. Mid-caps are for you if you are looking for an asset with a recommended time horizon of more than 5 years, and although you can handle the stress of occasional high volatility in your head, you don't particularly want to experience it often, unlike the small ones. Here too, of course, do your due diligence before you say yes to anything, or choose a fund even in ETF form that focuses on this size range. To conclude the grouping by size range, let's look at the big ones. Also known as large cap stocks, they typically have a capitalization of over $10 billion. They include, for example, the blue chip stocks that many people are looking for. As I mentioned at the beginning, capitalization changes from time to time. And some of these companies were in a smaller category a few years ago, but now they have outgrown it. Some of them operate in a sector where their market potential closely follows the current opportunities in the economy, and therefore their share price is also adjusted accordingly. Most of them, however, have a stable ability to pay higher dividends. These companies have lower growth potential than the others in the surveyed areas, but correspondingly lower risk and volatility. They are therefore less exciting for those who want to see a large increase in the share price compared to the initial share price. However, they generate predictable, reliable profits thanks to dividend payments. Because of this predictability, they also have less volatility than younger companies. You may wonder when this type of company is the right choice for you. The recommended time horizon here is also at least 5 years. After all, the fact that it is more predictable, it is still an equity. This type is right for you if you prefer dividend yields, but it is also good if you are looking for lower volatility. The latter is what you need if you don't want to take on as much risk as you would with other types. It's also useful if you already have a lot of assets with higher volatility in your investment basket compared to this, and you want to create some balance. You can also buy this type of stock by reviewing the company's performance to date yourself, but you can also buy it through an investment fund. The next aspect of the grouping is the breakdown by growth potential. This type of grouping was also discussed in the section on equities. There are companies that focus on growth and those that focus on value. Growth companies typically have a higher risk level, but the returns that can be achieved can be very attractive. These are companies that are experiencing dynamic growth. Because they are still relatively small, they have room to grow, and because they serve a market need for which there is broad demand. That doesn't necessarily mean you have to look for them in the small range. They may already be big and well known, but they can still show significant growth. The inherent risk typically comes from the fact that they are not the only ones responding to this broad demand, but also their competitors. So competition is fierce, and if their competitors disrupt business, the price can fall quickly. It is even enough for rates to fall occasionally that growth slows down because there is not as much demand for their services at that moment. Investors then fear that the long-term growth potential will be reduced. Do not expect too many dividends on shares of growth companies. If you get any at all. After all, you stand to gain far more from the share price growth than from the dividend that might be voted by the general meeting. After all, it is the reinvested capital that provides the impetus for their growth. The other type is value companies. Here the value is of course the intrinsic value of the company, and with it the exchange value, because a small company becomes big precisely by adding value to the client. Of the types of shares, these are considered to be more conservative investments. After all, they are well-known companies that have reached a mature stage of development. They are often the leaders in their industry, so there is little room for them to grow. In return, they have a stable demand for their products and a sound business model. If you choose this type, you get greater price stability, while also getting the upside of equities. Value companies can afford to pay even larger dividends. They can do so partly because they can no longer grow too much, so they don't need extra reserves. And the maintenance of their liquidity is not at all threatened by the dividends paid. On the other hand, since they can no longer be expected to continue to provide very dynamic exchange rate growth, they can meet their investors' needs by paying dividends and at the same time keep their exchange rate stable. You can also group shares by cyclicality. One group is cyclical shares, the other is defensive shares. The economy is cyclical, it rises and then falls. Depending on the sectors of the stock market, some stocks are more sensitive to this, others are less affected. Before you want to choose based on this, keep in mind that there is no 100% cyclical or defensive stock. Depending on circumstances, the performance of a given company may vary. Cyclical stocks are more exposed to the effects of economic cycles, hence their name. Examples of such industries include travel, transport, accommodation, travel agencies, vehicle rental, such like these, restaurants, banks mainly because of lending, but also the luxury goods sector and manufacturing. As the economy booms, these companies also boom, which means that their exchange rate also increases more dynamically. However, as the economy slows down, they will lose their markets faster than other sectors, so this will be reflected in their exchange rates. Defensive stocks are less exposed to changes in the economy. They include, for example, staple food producers and food retailers, as people need to eat when the economy slows, but also utilities. Their share prices are typically more stable due to sustained demand, and they tend to perform well in recessions compared to cyclical stocks. Finally, we look at the grouping by price stability. At one end of the scale are blue chip stocks, and at the other end are penny stocks. Blue chips are the most valuable in poker, which is how these stocks got their name. These companies are the cream of the crop in their industry, both holding the highest traded shares, and being stable and having a strong reputation themselves. The same applies to them as to companies with a large capitalization. Their returns are typically not the highest, but their stability makes them popular with investors who are less risk-seeker. You can also access blue chip shares through mutual funds, as these companies allow you to build a well-diversified portfolio not only through individual shares but also through investment funds. Penny stocks are the opposite of blue chip stocks. Their price is low, around a few dollars, but typically less than $1, hence their name. Their price can be highly volatile. The very low price can make you feel like you've caught a good buy. You can feel this especially when you compare it to blue chip prices. You might even be right. If the company later starts to grow, you have got shares for pennies that later become high value. But apart from this, this is more an area of speculation. After all, if the company cannot grow in production, then the shares of a low-value company will remain low.